Today's guest is Andrew Kahner, Managing Director and Private Wealth Advisor at UBS Wealth Management and co-founder of Connor Segal Partners. With over 17 years of experience, actually almost 20 years of experience advising entrepreneurs, executives, and high net worth families, Andrew has built one of the top-ranked advisory teams in New York and is recognized by Forbes amongst the nation's best. His team manages $2.5 billion, that's billion with a B, in client assets, helping successful professionals turn income into lasting wealth through UBS's liquidity, longevity, and legacy framework. Andrew's insights on strategic investing, wealth preservation, and legacy planning is invaluable for anyone serious about creating long-term financial freedom. Andrew, welcome to the podcast.
Thanks for having me. I appreciate it, Leo.
Definitely. And we were having a great conversation before we press record just about the intricacies of wealth management. I mean, I think the common mistake that people make is that they think there's one framework for everyone to build money, to retain wealth. But the reality is that it's quite complex and there's a lot that goes into it. And it's not easily done by just an individual, right?
Correct. It's a team effort. I think a good analogy that we were talking about is servicing patrons at a restaurant. You have 100 tables, one person cannot handle it alone. You have divide and conquer, you have sections, right? You have different people attending to the unique needs and requests of every table. And then you have management overseeing the floor. And then you have people working diligently behind the scenes in the kitchen to prepare the end result. So our business is often a lot like that. Where we have a team where we're dividing and conquering around the services to support our clients day in and day out as their lives evolve, as needs come up, as life events occur, such as marriages, divorce, births, deaths, business transactions. And we're there to help them and give them advice not only just on the investment result, but tax strategy implications, estate planning implications, and always coming from the framework of what does this mean for your near-term liquidity, the next 0 to 2 to 3 years? What does this mean for your retirement planning when you're going to be relying on your resources for the later years of your life? And then ultimately, what could this do for your legacy? How could you benefit others? How could you benefit organizations you care about? How can you make a difference and an impact today, knowing that that money is going to be earmarked for the future? So it's really important role we play. It's ongoing. 12 people on our team, because day in and day out, the situation changes and evolves, and we have to be there to guide folks around the ever-changing global economic backdrop.
That's interesting. So as far as your day-to-day, Andrew, like what does that look like? I mean, you guys are keeping up with the news, and I guess based on certain macro events, you're like, hey, look, Mr. Smith, I think based on this, you should adjust your portfolio because of this reason.
Yeah, so the day-to-day, for obvious reasons, our hours do revolve around the framework of market hours, bank hours. Market hours are 9:30 in the morning till about 4 o'clock in the afternoon. Bond markets start about 8 o'clock and go to about 4:30. And then we have the ability to trade in other markets globally and a little bit in after hours. But for the most part, my day revolves around interacting and spending time with clients. The better I can know them, what matters to them, who's important in their lives, the better we can frame an investment strategy that's bespoke to them to help solve for their concerns. One thing that's nice about UBS, and this is why we're not an asset management firm or a hedge fund who's really just trying to pool resources to build a model, we're bespoke in the sense that we're open architecture. So as a fiduciary, we can invest in almost anything that makes sense for a client based on suitability standards. So if a client wants to be in individual securities, we can do it. If a client likes to be passive and buy indexing, buy and hold, really cost efficient, we can do that too. We also have a variety of third-party private market investments with big and small institutions. And at the end of the day, what it means as a fiduciary is we put the interests of the client ahead of ours. And the way that's done is internally we're constantly reviewing the suitability permissions of different ideas, the checks and balances and our compliance officers of what's best for them. In addition, the way our compensation works is it's very streamlined. So there's no real incentive to recommend one thing over another. It's about doing what's best for the family, maintaining that relationship for years to come. And ultimately, the way we grow, Leo, is we get referrals from that family because we're doing a good job. And they might be talking about us at a dinner party while they're having cocktail with friends. And that person says, I want to meet them. I'm not getting that from the advisors I work with, or I'm getting limited coverage, or I don't have anyone to help. So we are always getting referrals and new introductions to help families that really want third eye guiding into good decisions.
Hmm. You touched on something interesting that I'm curious about, Andrew, is that you're open to sort of building a custom plan for people rather than having your own mandates on how you should be managing the assets, right? So how do you go about building that? Is it just taking directions from your clients, or is it like, hey, based on what I'm seeing out there, I think this makes sense? How do you guys go about that?
Yeah, no, it's a great question. It varies by individual. It depends on their financial acumen and their level of sophistication. So some clients do get a little bit more granularly involved in the ideas and the planning because they come from some basic financial knowledge, or they're just interested in the banking aspect. So we can plan and map things together and really have a thoughtful collaborative effort. But some clients are just very hands off. So what we always want to do is keep it simple and always come up with analogies or situational examples to get a better sense of their risk tolerance, their comforts, and what makes sense for them as we come up with an initial strategy. But I think what's important in this too, why we're always ongoingly monitoring and having that dialogue, is sometimes we don't get it right the first time, and usually not. Because just like if you're dating or if you're getting married, you get to know people better with time or situations. So develop that deeper connection with our clients, or the world is going through different periods of time. We evolve that strategy or that risk tolerance or that structure based on the client's ever changing landscape. Very simple. Someone might think you're very aggressive. But then when you have a very volatile market or some kind of global political event that's creating a lot of fear, if that client is proactively reaching us on a regular basis, very concerned, wanting to make sudden changes, they're probably not as aggressive and growth oriented as they thought. And that's okay. That's why we have a lot of ways to skin a cat and get them to a positive result. It's just about us pivoting the strategy a little bit that aligns better with how they're feeling about the state of affairs and their financial resources. And that's okay. And that's why for me, I got to get to know them and spend that time with them day in, day out. My team is really there to handle the day-to-day operational administrative services that come with being a banking institution.
Gotcha. Now, if you were to say break down, I don't know, like the 4 or 5 most important questions you would ask someone to just have a better idea of where they are, what their risk tolerance is, what kind of financial plan that you would give them, like what would those be?
Yeah, no, it's great. It's always tough to narrow between 4 and 5, but you got to start small and for the foundation, and then you build from there. So first and foremost, a really simple one is you got to get a really good handle on people's budgets and their spending. If you can solve for people's budgets and their spending habits, it can drive a lot of success. People have to have discipline with their spending, which does lead to financial success. Because if you make more money, but you continue to spend, it doesn't mean that you're going to be able to save and plan for your financial future. So that's kind of step one. You have to get a better sense of people's budgets, their cash flow, what matters to them in their day-to-day spending. And the best thing you can always do is if there's a way to automate their processes so that there's less requirement of action on the human part to make these sudden shifts in their saving strategy or their day-to-day financial planning, the better. So we always ask questions around habit, budgeting, and saving. That's first and foremost. Then, we want to know what matters to them big picture. Tell us about your family. Tell us about what you want to do in the future. If they're working, when do they plan to retire? Do they want to stop from their corporate work and shift to a passion of theirs? That's really important. Who are they supporting in their family, whether it's elder parents, children, or organizations that might take up a bulk of their resources? That's another really important one. And the last one is, what are their current or future liabilities? How do they plan to spend their money, and how can we solve that efficiently today? This is what I would say are some of the most critical questions, and a lot of discovery can come from that.
Got you. When it comes to just strategy and how you help your clients, like, do you see like a common thread of just, I don't know, like common mistakes people make when it comes to thinking about these things? Like, well, I don't need a team to manage my finances, like I'm good. Or maybe like an entrepreneur who's like, I don't know, all his, like 95% of his net worth is tied up in his company. He's like, well, I don't need a plan. I mean, my company is my plan.
Yeah. I mean, there's a lot of common pitfalls. I think one of the biggest ones is people try and time the market. It's very nerve-wracking to invest in an all-time high. People want to wait for a pullback versus investing and coming up with a disciplined and automated approach that takes subjective decision out of it. That's a huge mistake. Most people lose more money by just not participating today and now and waiting for that pullback than just participating, seeing the market continue to have some volatility or growth, and then how much it actually regresses before they jump in. So that's a huge mistake. I've had people waiting for a pullback for years who never pull the trigger, and they've lost huge amounts of wealth creation. Good rule of thumb, the stock market makes all-time new highs about 22% of the time. So about a quarter of the time, the market's at an all-time high. So it's no problem investing at all-time highs. And the other important fact that people should know is the market is positive 78% of the time and growing 78% of the time. So what that means, unlike going to a casino, the whole point of the casino is the probability of winning is against you. The casino's goal is to have you play for as long as possible with free drinks, rooms, dinners, because at the end of the day, that you are going to lose. It's a rule of math and probability. Stock market is the complete opposite. The longer you participate, the more you're in it, the better you're going to do. And that subjectiveness of the time when the market's not positive, the other 22% of the time, you take that out or reduce it by increasing your frequency of when and how you invest. You dollar cost average, whether it's weekly with a pay cycle, once a month. The more you do that, the more you reduce the probability of bad timing. But at the end of the day, by just participating with a degree of investment strategy around those time horizons, it'll work itself out. And the reason why we have that liquidity bucket of about 2 to 3 years, and that's usually cash equivalents or bonds, CDs, things that are fairly safe, is no bear market in the last 50 plus years, really the past 70 years, has been longer than 2 years. On average, bear market cycle where the stock market comes down at least 20% and then oscillates sideways usually to that period before making into a new growth or expansion cycle is about 20 months on average. And you can look at that trend over the past 50 years, that's what's taken place. A lot of that has to do with technology, just making the speed of execution, market cycles quicker. But what that essentially means, if you're worried about investing money for growth and it being a bad time, well, as long as you keep enough money segmented for your monthly recurring bills and expenses, outside of that volatility, you should be comfortable enough knowing that it's going to recover, it's going to perform over time. You have to show a degree of patience. And that's another big challenge that we have because of technology with things such as social media and our smart gadgets. We live in a world of instant gratification. So having patience for something like the stock market is really tough for people to do. And that's why like something you're familiar with, private market investments, can help people stay disciplined for the long term because you can't just press a button and sell on an emotional call and redeem something that quick. So it helps you stay in the game a little bit.
Yeah, it's true. I mean, the relationship between the private and the public markets is interesting because the public markets, it's, highly sensitive to what's going on in the world. Obviously, it's like easy to go in and out with relatively low, call it transactional costs, whether it means like liquidity or just like literally transactional costs, right? Compared to private market, it could be a little bit more costly, right? If you're buying a piece of real estate, there's like a lot of closing costs to factor in, and you're not able to sell it as easily as just selling a stock, for example. So how do you like view, I guess, the balance of like private versus public? Is there a rule of thumb, or is it like kind of super bespoke to everyone?
Yeah, it's a great question. I think the problem is a lot of other platforms where people can self-direct, they've gamified it, where the technology and the ease of doing it on your mobile phone allows people to pull the trigger. Certain platforms give you free money and free execution, but they're actually getting paid in other methods. I think some of that should have a little bit more regulation just to protect the interests of people. But for the most part, what we try to do is just take the hands and the control out of the clients. We can do things more on a discretionary basis. We will, because I think that's the best interest of the client. Discretion doesn't mean, again, we're pooling a strategy. It just means that we're trying to organize everything in a way for them, but taking the day-to-day button pressing and control out of their hands. But it's not easy, and every client's a little different. Sometimes, even though they're working with us, we still got to build that trust over time where they're turning over the keys to us.
Yeah, that's fair. Can't remember who said this, but someone was like, I think it was either Warren Buffett or Charlie Munger, who was like, the best thing about compounding, well, the eighth wonder of the world is compounding interest, and the ninth wonder is not interrupting the compounding unnecessarily. Because, like a lot of people, they freak out.
It was Albert Einstein.
Yeah, right. So, yeah, a lot of people, they freak out. There's the joke, right? The economists predicted 9 out of the past 5 downturns in the market. So, people are trying to time the market, trying to, flick their finger and like sell their stocks. Like they just end up selling at a bad time, and then they miss out on that big swing, right? Because April was a prime example, right? The markets like did a quick V shape and it just came right back up. And the people that sold, they probably missed out on big opportunities there.
Yeah, markets up 40+% from that bottom in April.
That's crazy. It's been 5 months or 6 months.
Yeah, it's a little scary, but
yeah.
Look, I have clients that sold out before that downturn, and they're probably up about 8% for the year. Mm-hmm. But if you had done nothing and you were in growth and you just rode the volatility, like you were in a foreign country, in a cave for a year, completely off the grid, and did nothing, came and checked your balance sheet now, you'd be up about 26% for the year.
That's
disrupting the timing. Forget the bad time, just disrupting, taking money out before the downdraft. You missed out on a huge compounding return. On $1 million, it's about a $200,000 difference.
That's crazy. Yeah, and for you, you work with clients of like, all walks of life. Especially on the higher end, right? Like with family offices and things like that. Do they view the market differently? Do they view things differently than, I guess, the regular person? Call it those that are making, I don't know, like a few $100,000 a year or something.
Well, I think family offices or pensions or endowments have a little bit more time frame in the sense of longevity planning, where they don't need money day to day, so they can think longer term with investments that are a lot more illiquid. And I think that allows them to achieve higher rates of return because you're rewarded for that illiquidity, which is a form of risk. So they just have bigger pools of capital that allow them to participate. You can, as you know, in the industry, there are also segments of certain types of investments that are reserved for institutional qualifying investors based on net worth rules. So for better or for worse, family offices can access certain types of investments that the average person just isn't eligible for, or probably doesn't have enough liquidity and capital to participate. I think that's changing with technology. You see a lot more like private market opportunities available to them in smaller increments. So I think the playing field is being leveled, but that's how family offices think. They have a less of a concern of the day to day, and they're thinking multi-generational.
And what about like individually, like wealthy people? I mean, do you ever have just like one person, maybe they don't have like a whole like back office behind them, like just one person that's like kind of wealthy?
Sorry, are there people like that we work with?
Yeah, and like so what I'm trying to get at is do wealthier people think differently than quote unquote like normal people, and like how so? Instead of like, because then when you're talking about family office, it's like, hey, here's like a team of like 10 people, right, to actually help out, versus like you know this one guy, I don't know, he's just like independently wealthy, and he has a different view on building wealth, on financials in general, to the regular folks.
Yeah, I mean, look, when you have a family office and there's more participants in the family tree, there's more disagreements on how to go about and proceed in the future. When it's one patriarch or matriarch, it's a little bit easier to make decisions, and the needs of the individual are different, and it's easier to structure. So I think process and decision making can be smoother when you just have one primary individual and not satisfying a lot of different of opinions, I would say. But when we set up family offices, which we do, someone has a liquidity event, sells the company, and we set that up, it does create a lot of complexity in the legal impact realm to set up official and optimize for every single participant within the family. But the rules as they stand today, it actually services well, because to have it satisfy family office obligations, the allocations and the portfolio design for each subsidiary participant is supposed to be different than the other. So it's not such a hard thing if you're trying to solve for, say, a generation 3, a generation 2, a generation 1 participant within a family vertical structure. Does that make sense?
Yeah, got you. So
Then at the end of the day, you're still solving for their liquidity, their individual longevity, their future needs. A family could have all the same investment strategies because they all agree, but this person has an 80% allocation to growth. This person has maybe a 60 or 50, and this person has a 20, just based upon some of those time intervals.
Yeah, that's fair. Yeah, I was just wondering if there's like ways, like wealthy people view finances differently than regular folks. It's like, hey, look, put all your money into investments, like just save enough for I don't know, like a year's worth of runway or things like that. Do you see those patterns at all?
I think the patterns are obviously different, and what they think about is different, but it's the same basic core principle needs. It's just the scale and the percentage budgeting to each category that gets focused on. Probably people who are living more paycheck to paycheck, focused on budgeting and saving, they're not really thinking legacy planning today beyond the needs of their children, but that's okay. You just keep the framework simple, and there's no reason to complicate and over diversify if the situation isn't warranted or it's not the interest of them.
Do you have like rungs of like each stage of that? Maybe like, hey, look, if your net worth is like, between 1 and 10, like you're good, just stick with indexing. And then maybe it's like 10 to 50. Okay, fine. You should think more about this, introduce more structure into your plan.
Yes, because the wealthier someone is, the more tax and estate planning considerations come into play, because a focus is necessarily less on growth and more about capital preservation, access to money efficiently, and wealth transfer, minimizing tax exposure. So those become more and more prevalent. The Big Beautiful Bill just raised the estate planning threshold next year between a couple to 30 million.
Wow.
So when people have a net worth beyond 30 million, this is where these strategies become really important. 30 million might seem like a lot, and it is, don't get me wrong, but it incorporates everything. Retirement accounts, businesses, real estate, insurance policies, benefits if they're owned in your name. So that can add up pretty quickly for a successful family who's had a good professional career.
Yeah. I feel like especially nowadays, with companies being worth more and more, I mean, I feel like a lot of the families, they build their wealth through, enterprise, right? Like starting a business and like scaling it up. And I mean, we have all celebrities like turning into billionaires left and right nowadays. So it's more achievable than ever.
Correct. Yeah, I mean, that's the other thing I mentioned in the beginning. Some of like the strategy and the planning can revolve around where you're starting from. What's driving the family value, what's going to be driving the liquidity, and counterbalancing things that might be illiquid or a family is maintaining, you want to offer up some balance around that too.
Yeah, that makes
So
sense.
for example, one's in an industrial business that's going to get maintained or so focus on the business in the future. From an economic planning standpoint, you want to have your liquid investments, your decision making be complementary to the different sensitivities of the nature of that business, like whether it's interest rates, whether it's tariffs as an import, like what affects good or bad that area of the market, and have investments that counterbalance that.
Gotcha. I mean, so in effect, it's to create a resilient sort of financial house, right? That could survive bull markets or bear markets.
Correct. Or, knowing that different investments are going to ebb and flow in different economic conditions, and knowing that you could need money at any time, you have different things that are accessible and make sense to take from to keep that level of efficiency where you're not subjecting yourself to bad timing that's going to have a permanency impact.
Makes sense. Makes sense. And let's take a pivot. Just as far as your team goes, I know you mentioned you have 12 people on your team. I mean, you guys have been at it for almost 20 years now. How's the dynamic evolved through time? I mean, I assume in the beginning it was just you, and then like you grew it out over time, right?
So what we always want to do is get ahead of the growth. We always want to add people to our team for efficiency to maintain before we need it. And we'll grow into the growth with the people. But basically what it comes down to is we know the services and needs that we need to provide to our clients, and we know what it takes in hours. We know how much each person added to the team can absorb in terms of client relationship, service, and tasks in a time efficient manner. Because whether they're our biggest client or our smallest client, their needs are all important and all the same. We have to make sure we're operating very efficient and having staff on hand that's trained to service them. So we have people as we go. We're in the process of adding another person now. And we want to take some time for 6 to 12 months to have them properly trained with the other staff before we're really ramping up and necessarily needed that person to handle workload.
Yeah, that's good to sort of give them a bit of leeway to basically learn the ropes and not just get thrown into the fire from day one, right?
Correct. We're in an industry that doesn't want to have mistakes.
Yeah. Yep. That makes sense. So, I mean, you guys are crushing it. I mean, like 2.5 billion under management. That's amazing. I mean, do you have a framework that you use to like build out a team like this? I mean, how do you get people aligned to your goals and just on it?
It's not easy. Part of the team dynamic structure depends on what your client book of business looks like. It could be very top heavy, or it could be a lot of headcount. It could be industry specialists. So that all matters to a degree. I think at the end of the day with clients, you want to find, or not clients, employees and staff, you want to find people who are team players. They thrive in a high pace, high pressure environment. Maybe they played team sports in college or had to multitask between doing well in school and having a job, have good communication skills, very personable, worked in hospitality or customer service. Those are very key skill sets that work well in this business. And I think the other thing is you generally care to be in the service of others, and you have a knack for finance and interested in it. And as people get granular in this business, what functions do you like to do? We can then develop career paths for people if you want to like investments and research. You want to focus more on planning and modeling. Do you just want to be of service to help people with their day-to-day needs and bill pay and make life easier? So as people on the team work, we're all cross-trained, but eventually people get pushed into areas that are more of their interest where they can thrive.
Yeah, that makes sense. And then I would assume like as your team sort of matures in terms of their roles, like you sort of just gradually create room for more, call it like fresh talent, right?
Yeah, usually we hire from within UBS where they have a couple years experience already. So it's usually in pretty good shape with the business, and they like it from a career.
Yeah, that makes sense. And How, I mean, just, I know every team is different, but like, how do you guys, maintain that culture, keep everyone engaged? Are you like a hands-on person? You try to do everything together, or are you like kind of 9 to 5, like, all right, I'll see you tomorrow?
4/7, we're very hands-on. You lead through example by being proactive, by following up, trusting people to handle their responsibilities, sense of ownership and participation in the team. But finding the right people is critical.
Makes sense. And looking back in your journey, Andrew, like, I mean, almost 20 years, like, would you have done anything differently, or would you want to tell your past self, um, something differently?
I think every day I'm learning. I think every day I'm trying to balance work. I
Mm,
strive to be the best at what I do, but I think you want to be mindful to not have it sacrifice your personal life and the people that you support and care about. And you having those regrets. Don't want to be one of those fathers that misses moments in their kids' lives because I'm working, even though I'm helping others. So what I try and focus on, and I've been doing this well, but I guess I could have started earlier if I was telling myself 20 years ago. I would have really hyper focused on only doing activities in this business, networking, or interests that are completely aligned with mine personal interest and desires because it's a great commonality point to find the right relationships. And if you're doing things that are your situation or your families and you meet great people there, then there's no sacrifice of time. So I think learning that lesson a little earlier and implementing it from the business, even if that meant slower growth initially, I think that would have been good.
mm.
But I picked it up pretty fast and learned. So didn't miss out on too much.
Yeah, that's good. Do you have like a framework on, deciding if you should spend more time with the family or at work or something like that, like decision framework for your time?
It ebbs and flows. When clients have an emergency need, we want to be available. And sometimes that's weekends. Learn to multitask very well. And I think people understand that I'm a person.
Mhm.
So if I have to take a call to help someone, but my kids are in the background and they're making noise, that's just life. Right?
Yeah.
That's what we are. Doesn't mean I'm not fully engaged in the conversation and helping someone. I just don't want to segment my time when I'm unavailable. I like to blend everything together.
Nice, nice. I love it. So, appreciate your wisdom so far, Andrew. I think this has been really insightful conversation. What kind of person or connections are you looking to meet? How can we as an audience sort of help you out?
Yeah, great question. So the two types of people that we really enjoy working with are founders, and they can be corporate executives where they're coming to a big exit or liquidity event. Maybe the company's going public, maybe it's getting bought out, and we really want to help them plan for that early stages. We don't want them coming to us when they have a term sheet or an offer on the table. I think when they're starting to have a lot of success and the business is really growing or it's now real and they can see that light at the end of the tunnel, it might be a couple years away, but they could see it. That's where we want to meet them because there's so much we can help them with right then and there from a tax and estate planning strategy just by being proactive, and following the rules of the game to make a big difference in all the value and wealth that they've created for themselves before they access it. It doesn't matter the industry, but usually that aligns with a lot of technology. Fintech has been popular, industrial, artificial intelligence. Those are great areas of founders making a difference and innovating in the world. The other one is if people are selling businesses, it could be like mom and pop, industrial. These are also of size and they want to now build that family office. That's really important too. And maybe they're doing that because the next generation does not want to run the family business anymore. So they're cashing in. But you've gotten used to in that life running a business with certain business expense deductions, tax efficiencies, and a style that you want to maintain. So setting up a family office is a very complicated process and design that has to be maintained with checks and balances along the way. It's not just setting up an entity and once you have it, it's off to the races. There are things you have to do ongoingly to maintain good standing. You're basically setting up a C corporation. So helping people do that and being part of their leadership team that drives those processes so they don't have to deal with it is really critical, because the savings and the difference it can make from the enterprise value people build is tremendous. And I really get excited about doing things and giving people advice in areas that we can make a difference just by being proactive. We can spend a lot of time and energy on investment, research, selection, but at the end of the day, a black swan event or something that blindsides the market can totally wash away all your preparation. But the items I'm talking about, these are just tax and estate rules or structuring rules that are the law. So just knowing that information and guiding people for their situation can give them instantaneous return just by planning. Seems easy, but takes a lot of time and work, as we're corralling the vantage points of their CPA, their estate attorney, sometimes a corporate attorney, and we will drive those conversations with the client and schedule and plan. But we want those people to participate because we know about 90% of their world and enough to be dangerous. But we got to have them involved because they're going to know a little bit more. It means people.
Liquidity events are no joke. I mean, I think there's so much to be had, like so much efficiencies to be had for tax and estate strategy, and just planning it ahead of time. I think that's the key, right? Maybe like a couple of years out at least, shape up your P&L, look good for offers, get you a good offer, get you a good efficient way to, manage your cash flow afterwards, right?
Yeah. I mean, look, the earlier people can connect with us, the better. It just means that there's more optionality for them to pursue. There's definitely things that can be done after the fact. But
that's fair. So how can folks get in touch with you?
Well, I mean, we have a website. So even if you just Google my name, Andrew Kahner, Kahner, put UBS in there or not, but my company website and a lot of my contact information should be splattered across page one of the search engine tool.
Perfect. Well, Andrew, thank you so much for your wisdom. Thanks for coming on.
I appreciate it. Thank you, Leo.
You bet. You bet. Alrighty. I will talk to you again soon.
Wonderful.